Welcome to Multibagger Shares. I am Manish Goel, SEBI registered research analyst. Registration number INH100004775. Today, we are going to talk about one of the most powerful yet underused valuation tools in the world of investing, EV to EBITDA. If you have been relying only on the price-to-earnings ratio to evaluate stocks, you may be missing a much more complete picture. Let me explain why. The PE ratio only tells you what the market values equity earnings at, but it completely ignores the company's debt. Two companies in the same industry, one heavily indebted and one completely debt-free, can have wildly different PE ratios even though their core businesses are equally strong. This is where EV to EBITDA fixes the problem. Enterprise value, or EV, is the total cost of acquiring a business. The formula is simple. EV equals market capitalization plus total debt minus cash and cash equivalents. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It is the purest measure of a company's operating earnings power. Stripping out financing decisions, taxes, and accounting choices, when you divide EV by EBITDA, you get a ratio that tells you how many years of operating earnings it would take to pay for the entire enterprise, debt included. For Indian stocks, here are general benchmarks. Below 6 times is typically deep value territory. Between 6 and 10 times is fairly valued. Between 10 and 15 times reflects growth expectations. And above 15 times suggests a premium valuation. However, always compare within the same sector. Cement stocks typically trade at 8 to 14 times. Steel can drop to 3 to 5 times at cyclical lows, creating extraordinary entry points. FMCG commands 20 to 35 times due to strong brands and high margins. The best way to calculate EV to EBITDA for Indian stocks is using screener.in. Go to the company page. Note the market cap, total debt, and cash from the balance sheet. Then calculate EV. Find EBITDA from the P&L section. Divide and compare. The most powerful use case is peer comparison. If two cement companies trade at 12 times and 7 times EV to EBITDA respectively, with similar fundamentals, the 7 times company deserves a closer look. Combine EV to EBITDA with revenue growth trends, EBITDA margin expansion, and debt reduction for the complete multi-bagger framework. Remember, the goal is not to use one metric in isolation, but to build a multi-layered picture of intrinsic value. For the complete blog post, the link is in the description. Join our Telegram channel at t.me/longtermequityy for daily insights. This is Manish Goel from Multibagger Shares. Invest wisely. Invest long term. Thank you.